If you look at gold, it really is the type of thing you own for the long run, and it will have periods where it doesn't do anything. It doesn't do as well as the market. But if you look at it for 15 and 20-year periods, if you get some selling or you go through a bear market, which is usually about a year and a half or so, and you have some liquidity, that's where you can really make some money. And that's where we put money to work and feel good about it. And everybody else is going to be nervous. They're going to be, they get really nervous at market when markets have been bad for a long time. You have to think that he probably has had some pressure from the White House. If you think about it, the biggest problem for them right now has been inflation. And so I think they want the street to realize that, hey, we're doing something about it. And they probably had a conversation about that. If you remember, well, you wouldn't remember necessarily, but I do. Back in the late 70s, we had the whip inflation down buttons and all that sort of thing. But that's when the president really talks to the Federal Reserve and says, hey, you need a little help here. I think that's probably what happened. I think it's interesting because he's coming in at a time when the longer bonds are actually drifting, rates are drifting lower. So if he moves the short rates up, you're actually going to start to really flatten the yield curve. I think, we've looked at a lot of the periods going back in the last 100 years when there's only 3 or 4 where you had inflation, late 1800s. But if you look at the 40s, they seem to us to be more like where we are now than the 70s, because in the 40s, we had a war, much like, what we have now with COVID. But so they kept the rates really, really low during the 40s. But then as you came through the 40s, interest rates, inflation went higher, but they kept the rates really low. So that by the time you got into, the mid to late 50s, actually the debt to GDP was a lot lower, but not because they did anything differently. It's because the declining purchasing power of the dollar made it cheaper. And so that's how it ended up. It seems more like that to us now than it does the 70s. I'm not qualified as a scientist to say anything about it, but I would say this: if you look at the beta, the delta, COVID, the original, and now we have number 3, it seems as though what happens is everybody jumps to these conclusions that it's going to be really terrible. Now, it doesn't mean that it doesn't spread, but as far as the severity, I don't think we have a big enough sample to know that at this point. If you look at it, most of this stuff is coming from places where, they're not vaccinated. And so that's our big problem, I think, worldwide, but it's too early. If you look at the samples, I pulled it on Monday morning. I just looked at the cases worldwide, at least as many as I could see. And I don't think there were more than maybe 200, maybe 210, something like that. So I just thought it was too early for us to determine because we didn't have a big enough sample at this point. I think the knee jerk might be to do that, but if you think about it, tech did really, particularly what I call stay-at-home tech, but a lot of the tech did well during the COVID period. And so we still own our tech. We really haven't taken much of that off. I think it will continue to do okay going into the first and second quarter. Now, mind you, we own the kind of tech that makes money. We don't own a lot of these things that don't have any revenue or don't have any earnings. But we think that probably would continue. It is the long-term one. I think what has really sort of bothered a lot of people is if you look at the last year and a half, it's been reasonably flat. It got up to 2,000 and then it's broken back. It may not be finished in this consolidation. For us, we own the gold and the miners we own. We don't, it's not it's about a 4% or 4.5% position for us. We own those for the long term. And because if you look at gold, it really is the type of thing you own for the long run. And it will have periods where it doesn't do anything. It doesn't do as well as the market. But if you look at it for 15 and 20-year periods, it does well. And it certainly does well when the currencies are under pressure, or particularly when we're going through what we're doing now from a debt standpoint. We don't own crypto ourselves. However, if I were recommending something to someone, it would be, take whatever position you're going to take, whether it be 2% or 3% in the larger, either Ethereum or Bitcoin, something along that line, and just own it. I don't think you're going to be in a position where, it moves a lot. So I think in the end, we've gone from what was 1,000, maybe a few hundred cryptos to, 10, 12,000. The number keeps going all the time. I think that's too many. And we think it'll be a lot like the tech stocks of 1999, where a lot of them won't make it, but some of them will. And so you stay with the biggest and the best, and just take a percentage. That's the way we would do it. Now, I'm sure people disagree with that are big crypto fans. We actually, believe it or not, we owned crypto when it was really cheap, the Bitcoin back, and it was less than 1,000, and we sold it at around 20,000. I think it was December 17 or right around that time. And we never went back to it. It wasn't because I don't think that it has something to offer. I certainly think it does. But now with this proliferation of everything, I do feel like, and there's been a couple of studies that just came out in the last 45 days where the SEC was involved, and the CFTC and the OCC. And what they're saying is look, we are on the look for this stuff, okay? And we're going to decide whether we want to regulate it and how we want to regulate it. We look at is we buy things we think are a good buy. They're things that we think are undervalued, and everything we own either pays cash flow or it has really good earnings to it. We don't go in for things where maybe they're going to come into fruition 4 or 5 years from now. So we think there's a number of stocks out there that are selling at, many, many times sales, which is ludicrous, really. And many of them out there that are selling very high prices where they don't make any money at all. We think all of that stuff will be eventually detrimental to investors. However, I think you have to be balanced. And for us, the balance looks something like this, which is, okay, we want to own the companies we think can really grow through even tougher times, which we do. We want to own income items where we can get a really good piece of cash flow. And then we want a piece of safety over here where we know, okay, and it's what we call living to play another day, is that you have a safety valve and you have that piece of your portfolio where, it'll keep you from having to get really, really wrung out if you get a big sell-off in the market and you've got a piece over here that's really safe. It keeps you emotionally stable. And I think that's the biggest thing you have to worry about as an investor. If you look at our overall liquidity and we put all three strategies together, it's close to 35% right now. And there's reasons for it. We're not buying any, we've stayed away from the bond market a lot the last 12 months. We started looking at it a little bit closer now, but we have a lot of liquidity. So when you do get, and it's hard to predict, but if you get some selling or you go through a bear market, which is usually about 1.5 years or so, and you have some liquidity, that's where you can really make some money. And that's where we put money to work and feel good about it. And everybody else is going to be nervous. They're going to be, they get really nervous at when markets have been bad for a long time. However, I think people need to realize that's an opportunity if you have liquidity and you use that opportunity.